Hello, good morning, and welcome back to a CLA webinar. We have a really exciting session for you all this morning. We're going to be doing an assessment of the fintech lending industry in Canada, where it's come from, where it's going. It's been an incredibly exciting week, obviously, with the American elections, looking at the public markets. Things are pretty wild. So really excited for today's conversation. Also, a big thank you to our sponsor and supporter, TransUnion. You're going to be hearing a lot from TransUnion over the next hour, and I encourage you to connect with the team or with Matt afterwards to discuss some of the solutions that they offer. So with that, I'm going to hand things off to your moderator, Mark.
Thanks, Tal. Yeah, thanks, Tal. Welcome, everybody. Happy early Thursday morning, and really looking forward today. So I'm Mark Reisler. I'm the Managing Director of Lending over at FGS, where we tend to focus on growth strategies for large financial incumbents. And today we're going to try and separate the conversation into a bunch of segments. So segment one, we're really going to dive into what's happening with the alt lender and the lend tech landscape. Segment two, we're going to take it from an empathetic point of view and trying to understand our borrowers. And then if we have time, we'll go through some quick fire questions and open up the Q&A a little bit more. So before we get started, I'd love to introduce our panel. Kevin, why don't you kick us off with an introduction, and we'll go from there.
Great, thank you, Mark, and thank you, Tal, and the CLA team for putting on the event. My name's Kevin Clark. I am the Chief Revenue Officer for Merchant Growth. I have, I guess, about 5.5 years under my belt in the fintech lending space, having founded Lendified back in 2015 and Judy.ai shortly thereafter, and managed through the challenges of COVID and have come out on top with Merchant. Merchant remains one of the premier lenders in the small business lending space here in Canada. And prior to my fintech years, I spent 30 years with the Bank of Nova Scotia in a variety of lending positions, and so come at this space with a lot of different background, be traditional lending, and now in the modern world of fintech lending. And it's been a fascinating ride, and I look forward to being a part of the panel. Thanks, Mark.
That's great. Matt, do you want to go next?
Sure. Good morning. I'm Matt Fabian. I'm Director of Research and Consulting at TransUnion Canada. For those that may not know, TransUnion is a global information services, data and analytics company. We provide not only credit solutions, but other data fraud and analytics solutions for the lending industry, including fintech. And part of that, I was in roles in strategy and analytics roles at one of the big 5 banks for about 18 years. And part of that was in management consulting. So really excited about this topic, high growth area. We've been monitoring it worldwide, certainly. I know a lot of the folks on this panel, I think it's gonna be a great discussion.
Great, thank you. Jason.
Thanks, Mark. Good morning. My name is Jason Appel. I'm the Chief Risk Officer at goeasy Limited. Been with the organization there for just under 8 years. goeasy is one of the larger non-prime lenders, publicly traded non-prime lenders in Canada. We've been in the business for about 15 years, give or take. Got our start, if you will, in the leasing business, which we remain active in across the country. Really happy to be part of today's panel. Lots of good dialogue and discussion, I'm sure, to be had. It is an interesting time to be a lender in the Canadian market, never mind globally. So looking forward to exchanging thoughts and views with my panel colleagues.
Great, love the balloon in the background, by the way.
Thank you. That just reminds me how old I am. So thank you for that.
Perfect. And Jeremy?
Yeah, thanks, Mark. Good morning, everyone, and thanks, Tal, for inviting me to be part of this panel. So I'm Jeremy Kronick, Associate Director of Research at the Howe Institute. The Howe Institute, for those who don't know, we are a nonprofit that does economic research and advises on public policy. So I run the financial services and monetary policy research programs there. I'm an academic by training, so it's my background. I've been at Howe for about 6 years. Focused very much there in the research space on productivity, the future of financial services sector, and then on the monetary policy side, sort of the implications of the Bank of Canada actions for the financial services sector and for the macro economy at large. I'm just really looking forward to being part of this panel. I feel a little bit outside my wheelhouse and some of the sort of specifics around alt lending, but I'll do my best to provide sort of a macro perspective and some of my views in the overall sector.
Jeremy, I think you're going to be just fine. We'll go easy on you. Okay, so why don't we get into this? Why don't we kick things off? FGS, we recently just updated our database, and we're showing now about 191 different lendtechs inside of the ecosystem in Canada. And when we were going through a lot of the research, we found that the alt lender landscape is really only making up about 16% of the overall market share in the economy today. And that means that the credit unions, the banks of the world are picking up the remaining share. So I want to kick this off, and maybe Jeremy, you could help set the stage for us a little bit around, from a macro level, what's happening in the lending in Canada right now. We got the increase in liquidity because of the government stimulus. Can you just kick us off, very high level macro, what's going on in lending in Canada?
Sure. I mean, I'll just start off with a few thoughts. I mean, if you look at the household and business credit data, and you look at the month over month numbers, the year over year numbers, I mean, you certainly see some negative growth on aggregate month over month. You don't really see it year over year, which is interesting, and you really haven't seen it through the crisis. Where you do see it when you break it down further from the aggregate level is really in the consumer credit side. I think the real estate sector, obviously residential mortgages, stayed pretty strong in part because of the mortgage deferral program. Business credit certainly month to month, month over month took a bit of a hit. But really the consumer credit side to me was the most noticeable spot. And so I think it shows, in terms of where it was a little bit better than perhaps we thought it would have been at first. I think to your point earlier, I mean, the government programs have been huge here, and the Bank of Canada's measures have been, I think, equally as important. They've injected massive amounts of liquidity into the sector. I think it's been, responsible for keeping financial markets in pretty good shape. You saw corporate spreads spike and then come back down after the bank really got involved there. I think there's obviously some questions to worry about. What's going to happen to those programs when they end? We saw some delinquencies in September sort of start to creep up. We know that there were some issues even before COVID. So I think there's some question as to what's going to happen when those programs end. Also, what's going to happen when the term repos roll off the balance sheets and those balance sheets start to shrink a little bit. Are the banks going to get as involved? And so there might be some room there for the alt lenders. I could go on, but maybe I'll just stop there since we have three other panels.
But you know what though, Mark, what's interesting is that, our industry hasn't really traditionally looked at market share to sort of drive our success in the space. I mean, frankly, as startups and as, new into the financial services market, financial technology lenders, it's really about how do we compare from the previous month? I mean, are we comparing ourselves to ourselves? Are we comparing ourselves to our peer group? Certainly, we're not comparing ourselves to the broader financial services stability that's out there with institutions that have been around for hundreds of years. I mean, it's about meeting the needs of cash flow and yes, serving the industry. But market share hasn't really played a role in defining our position on the map.
Jason, same thoughts and opinions from the goeasy side?
Yeah, I would agree with Kevin. I mean, as we classify the market for non-prime, never mind the entire market. I mean, that's sitting ex-mortgage at over 230 billion. We have just over $1 billion of that. We're not even a speck on the overall map, and yet we're considered to be a large player in the space. So I would agree with Kevin. We don't tend to define ourselves by how much market share, because the non-prime market, at least, is growing at 2 to 3% annually, which means you're getting $5 to $6 billion of new growth entering just into that segment, never mind prime, near prime, or above. So I would agree. We don't define it that way. But as far as overall lending is concerned, I would say it depends on who you ask. I would say, broadly speaking, the market is still coming back. As a business, we obviously just reported our numbers a couple of days ago. We're marginally ahead now of where we were last year, but that's through a lot of creative and very tactical engineering work. most of the market, I would say, still hasn't come back year on year. They're certainly up month on month or quarter on quarter. And I think that's because we all got slammed when COVID hit in March, April, May, and the excess liquidity that came into the system didn't transform, in my view, into additional debt. It transformed into a pause on additional debt. And insofar as a lot of lenders, or a lot of consumers rather, weren't looking to get more debt. They were simply looking to stay alive with the debt they had.
Right.
You couple that with the deferral programs that most of the major banks and some lenders put into place. And what that excess liquidity wound up doing was lowering the overall debt to income ratio, not by changing the debt levels, by boosting the income levels. So we as lenders, or alt lenders as we're so defined, I would say our business is still rebounding. It's certainly trending positively, I would say personally, but I still think we've got a little bit ways to go, probably a couple more quarters. And in light of the fact that the economy is likely going to enter somewhat of a marked slowdown in Q4, just because we've come up from such a low point in Q3, and I'm talking fiscal calendar quarters. I think the future looks bright, but second/third wave, depending on who you ask, still casts quite a long shadow of uncertainty. So I'd say we're optimistic, but we still have some way to go to get back to where we were as an overall industry, I would say.
Yeah, and Matt, would love to hear from your end as well around the state of evaluation of risk, evaluation of people as well as businesses. How's TransUnion looking at this, and yourself looking at the current market that we're in?
Yeah, I think it's interesting, and I think the Jason's points resonate with me a lot, because what we saw coming into this crisis was elevated household debt, right? We heard about it in the media, we heard about it in the news, and the big story was always Canadians have more debt than any other G7 country per capita, right? So right. That was already sort of an issue and a stress on the economy coming into this. My view had always been that's only one side of the balance sheet. Wealth and income was also growing at a pretty good rate. So again, when you look at that ratio, it seemed a little bit aligned. But the big question coming into COVID was going to be what happens when sort of this, the shock hits, right? With people already in debt. And I think Jason was right on in that what we've seen is folks just wanted to get through this crisis, right? So our financial hardship survey that we put out, that was the sentiment. People were not looking at taking on more debt. People were trying to figure out, how do I get through the next month or the next 3 months? And that was really the focus. And I think, obviously the government relief stimulus packages were really useful and warranted. I think the lending community really stepped up. There were about 3.1 million Canadians, about 11% of the credit market took some kind of deferral. And we're starting to see that run off, right? So we're starting to see about 63% of the card portfolio, the deferrals have started to run off, about 54% in personal loans. And I think to Jeremy's point, we haven't necessarily seen a material increase in delinquencies. We've started to see a little bit of a creep up, but it hasn't been a huge sort of cliff that maybe some people had worried about. And so I think, early performance remains pretty positive, but as a couple of people have already mentioned, there's a long tail to this. If there's a second wave, it could put a lot of stress on an initial shock on consumers. And, it's sort of one of those things, you can get punched in the face once and get up, but maybe not the second time, right? So that could be, and I see that where this industry really steps up, right? What happens typically, especially with the larger players, is they have these sort of, not always, but there's sort of these uniform underwriting policies that kick in, right? And you put these cutoffs, and there's folks, again, they're trying to get through the next couple of months where they're trying to get access to credit, access to liquidity. They might not get it from some of the traditional channels. And I see this industry really stepping up and really playing a big role in that. That happened in the US, certainly in the 2008, 2009, it gave rise really to the Fintech industry in the US. And so I think, I see that here. And I think, again, with performance, Canadians have historically been pretty stable in terms of their credit performance. And so I think, that bodes well for the industry.
Matt, the elephant in the room on this, of course, is that the alternate lenders amongst us here that have been providing capital into the small business community and the lower end of the commercial markets for quite some time are exactly the ones that got caught with the challenge of the COVID experience and the declining economy at the time and the as Jason called it, the offset to all the government funds going into the marketplace. And what was really unfortunate was, to your point, noting, Matt, that the US and in Europe, the distribution of those special needed funds, came through a variety of channels, including the financial technology channel. And we got overlooked in Canada, notwithstanding the incredible distribution that we provide and the capital that we've provided into the market. And the only real silver lining on that is that we got noted that we weren't actually a part of that distribution. And so we've sort of gotten the highlight the wrong way, that this community does exist and plays a critical role in supplying capital into the low end of the commercial markets.
Yeah, I think it's overlooked a lot in this industry is, that stigma. It's not maybe necessarily as prominent as it was, but that stigma of fintech is, a bunch of lenders that lend to subprime, and they're the worst of the worst, and they're kind of in this little. But a lot of it is based on the ability to build technology and build platforms and build customer experience and build speed that maybe doesn't exist elsewhere, right? And I think that I agree that I think. Those are the attributes that in a time like this, when speed and time to decision, things like that are important, could have really been something that the Canadians could have leveraged.
Yeah, I think it's a bit more than that though too. I think it's to Kevin, your point. You have access to a certain set of small medium businesses that are getting rejected from the big banks, that are maybe on the near prime spectrum of prime, and by you having that type of access to that SME, or by goeasy having that type of access to that consumer, what we're really doing here is that we're giving a fighting chance, to be quite honest with you, to the plumber out there, or to the lower income family of four that really needs this. So I agree with you that the distribution channels, we should have thought about this a little bit more directly. But maybe you could touch on the type of access that you do have. And I know that I'm going a little off script here, but those SMEs that you're reaching out to, those small businesses that you're reaching out to, I'd love for you to just kind of give us a sense of what that looks like in your domain, how you view them, how you evaluate them. What type of needs you're solving for them.
Well, all that, of course, has changed. Every one of us on the panel today will have a view that's today and the view that we had 6 months ago or 8 months ago, and they're probably different. The reach for capital, there is it's like the car industry 10 years ago. Everybody's retooling, right, to a lower sized organization and operation, and trying to understand how they gain growth out of today's economic environment. But the reach has traditionally been broad, whether it's for Jason or anybody else in the consumer space and in the commercial space, that we have always felt ourselves fundamentally compatible with the larger institutions, because we play in a segment that has been challenged for them, and that we have found ways to actually provide capital with a value proposition that is really well respected by the small business community, because everybody needs access to capital for growth. And if you can't get it in traditional ways, you get it through ours, which is really quite dynamic, and obviously leveraging all the nuances of data and so forth that we all talk about today. But there's been no change in terms of broad coverage model that we have today from where we were 8 months ago. I think the difference is there are certainly, based on people's balance sheets, some people are trying to refinance down and are really skeptical of borrowing. And for those who have sort of retooled or happen to be in the economic space today where business is actually okay, there is growth out there, and we're funding that and underwriting that growth, which is actually quite exciting. We might be down 50% from pre-COVID, but I wouldn't say we were down in terms of the industries that we're trying to cover. Even in the food and beverage space, there is business being done, and money is going out the door to support small businesses. But I'll stop there and let maybe Jason's got comments on the consumer side.
Yeah, we're probably not different in that. Obviously, my perspective is, and I think I said this before when Kevin and I sat on the CLA panel that occurred last fall. A good risk manager, never mind a good revenue manager or any business leader, is planning and managing their portfolio to perform well in bad times. And the time to take those adjustments and make those modifications is generally in good times, because those bad times, when they come, they tend to, hit you upside the head like nobody's business. Now, in this particular recession, we all got a little bit of a break in the form of government stimulus, in the form of lender deferral programs, in our case, in the form of having ancillary products that provided a good portion of our customers with additional coverage to help them pay their bills. But that doesn't mean we weren't modifying our underwriting and our credit along the way. And I think what this particular recession has taught us is that you can't take those kinds of things for granted. You've got to be dynamically adjusting your criteria, because I would tell you the best time to grow share, not that we play our game by growing share, unlike Kevin and other lenders, is the best time to actually grow your business is coming out of a recession. Because yes, in this environment, you're going to pick up disenfranchised individuals where the banks are going to choose, or the credit unions are going to choose, or even the large alt lenders are going to choose not to want to lend. And that opens up a huge opportunity for small business and consumer focused lenders to say, hey, give us a try. Here's our experience. We can underwrite you. There's a price for that underwriting, obviously, because it carries a certain risk return ratio. But we're now able to service you in a past where your bank has basically said, yeah, I can lend you up to here. And after that, the till is gone and you got to go somewhere else to find your money. Oh, and by the way, keep paying me on time or else. I think in this type of environment, it's an opportunity for the alt lending space to actually grow its presence in the market. And that's going to take a combination of a little bit of support from the funding overseers to keep our businesses afloat, and our willingness to be a little bit more dynamic when it comes to changing our underwriting approaches and to be a little bit more creative, because that growth is there to be taken. Notwithstanding, certain industry sectors are going to feel it, but there is plenty of growth out there. You just got to be willing to take that risk, price for it, and figure out creative ways in how you want to underwrite it. That would be my view.
Yeah, and I love the comment around we need to change our way of evaluating or enhance the way of our evaluating and adjudicating and overall underwriting. Where does data come into this play? Where does the use of alternative data sources come into play? There's a lot of fintechs coming into the market, providing connections into hundreds of different APIs, vast amount of ways of connecting the consumer as well as the SME into the non-traditional data sources. Is that a tool that we could also start looking at to evaluate people, evaluate companies, evaluate organizations differently? Jason,
I'll stop at that one. I'll start, and I'd certainly welcome feedback. I believe the way in which we can differentiate ourselves as a group is to be a little bit more creative. And in our particular instance, it's about alt data. We've been consuming, for example, banking data now since about the mid-year of 2017. And as we announced in our press release yesterday, in September, we launched our first generation of banking models that now assess and evaluate customers' credit risk in combination with credit bureau data, application-related data, and so forth. And that's giving us an opportunity to tap into segments of the market we would not have traditionally been willing to underwrite or approve. In some cases, we're lending to individuals exclusively on the basis of their banking information, and in not having a credit history or a little credit history, i.e. a thin file, or an imperfect credit history in that they've got a blip or two, either a past bankruptcy or some worst kind of rating ever that a typical bank would instantly shy away from. So for our business, it's all about the data. And because we can't necessarily always compete on price. We can't necessarily always compete on distribution. The banks and the credit unions tend to have that area, well in hand. So, one of our differentiators is, we like data. We play in the data, and you've got to start acquiring, purchasing, and investigating and validating that information quickly, because it's going to take a while to figure out how to go out and use it to get those customers to come to your door. So I would say it starts with data. It starts with being creative on how you use data, whether that's reformatting great data that we get from our partner TransUnion and looking at some of their new algorithms and formulas, finding other data like from banking, figuring out how web-based data comes into play, leveraging StatsCan-based data. I could go on. We could take a whole hour just talking about data, but there's plenty of that opportunity. And I would say as an industry group, we can lead in that space because the banks, unfortunately, are not as able or willing to play in that space in the same way that we are.
And Mark, it's not without its risk, because the data that we discover and mine and the hypotheses that we put together takes time to figure out. I mean, it's not like it's instantaneous. You have to actually put it into the marketplace and underwrite and monitor performance. And that's over the life of an existing relationship in its own, and over the life of a portfolio for proper analysis. And that's, to Jason's point, I mean, you start in 2017, only now do you start to really know what you've done right and what you've done wrong. And the cost and exposure and risk to that is significant. And that's hard for smaller businesses in this space. I mean, Matt's probably got a view on this for sure, but we're all pulling all kinds of data and exploring it. But at the end of the day, one has to wait for the portfolio to perform to know whether the data is applied properly and can be used in an underwriting capacity and win the day over time on making good decisions.
Yeah, I agree. I think, one of the things we're seeing is obviously more data is always better in terms of being able to make a decision. The type of data, the quality of that data, the frequency of that data are all, obviously things that would impact your ability to, make better decisions. Certainly, what we've seen from this industry is a willingness to experiment. We've seen a huge willingness to get into things like machine learning, AI, and adopt those kind of technologies a lot faster than maybe the traditional banks, although they're doing it. I think there's a lot of risk rules, risk policies, and things like that maybe prohibit how far they're able to actually deploy those things. I think what we're starting to look at is how you use that data in the context of not only the breadth of it, but I think just also how you use it for other things, like looking at identity management, fraud, all those kind of things that, traditional credit data or traditional data that you've seen might, you might have ingested it and used it for one thing, but you can quickly look at it and say, hey, we put a different lens on it and it's useful across a couple of things. And I think that's what, companies, certainly like the ones on this panel, certainly like a lot of folks probably in the audience, are able to do, because they're a lot more agile in terms of their ability to pivot and adapt. But I think Kevin's point is very well taken, that it's a lot of test and learn, and it's a lot of experimental design and a lot of rigor around trying to figure out, as we bring in these new views or this new data, how far do you go before you're unintentionally increasing your risk, and how do you test those things, right? And how do you build those types of scorecards and other whatever you're trying to do. I think the other thing that's going to happen over the next couple of years is, with the continued evolution of however open banking looks in Canada, those data sources are going to become more and more and more prevalent, right? And consumers are going to drive a lot of that. And so, again, the caution would be, once these kind of taps open up, understanding how you use it and what the relevance is to your business is going to become critical, because there's going to be more and more opportunities to leverage that.
So Matt sort of stole what I was going to jump in with about open banking, because I do think, listening to all of you guys talk about data, it strikes me that when we think about this is my macro hat again, we think about policies that governments should be thinking about in terms of the recovery. Boosting productivity is really a critical part of how we're going to move and close the output gap over the next couple of years. And it, the open banking thing, from my perspective, has been frustrating because it's been so slow, right? And to your point, all of you guys made the same point around speed and the time it takes to take all that data and turn it into, a portfolio that benefits the borrower, benefits you. And we are falling way behind what other jurisdictions are doing with respect to open banking, that I think we have to continue to push. And I know the government just came out the other day with their announcement about moving to the second stage. And I put out a paper a couple months ago with a colleague at Queen's University on sort of how we view the implementation of open banking. But for me, above all else, just get it going. Get it pushed forward so that there is this ability to take this data, use it, and really turn a slow growth recovery, perhaps move it along a little faster.
If you want to tap into underserviced or underbanked, pardon the pun, segments, you've got to be willing to play in that space. Again, having been in there now for 3 years, I will tell you there is a richness and a robustness of the data there that has multiple applications, not just for credit, for loyalty, for cross promotion, for partnerships. It's extraordinarily valuable. And even if I look at markets, for example, in the UK, where open banking is prevalent, it's only to an extent where that information has now been started to be integrated into, let's say, credit bureaus, which adds some value. But I will tell you, getting the customer to provide the access to their transactional data history is a wonderful tapestry, if you will, into how they're managing their affairs. And not so that we can go in and predatory lend. That's not what we're talking about. We're talking about going in there and giving these customers value-added services that align to what their behaviors suggest that they ought or should be doing. And you can get a lot of that, as I said before, from things like credit bureau or application data. Things like open banking or things like banking data in general, or other sources of well-articulated, well-defined data are extremely powerful in that they just give you an insight into the customer that, how they may be managing their credit in general just cannot provide, because there is often a dichotomy between how customers manage their credit and how they manage their cash flow. Any small business owner will tell you that. So it's very interesting that source of information, again, among other types, will change the landscape. And I would argue it's a race to the finish insofar as who can ever tap and leverage that information first, not without taking some risk, will really be able to open up new segments of the market that the traditional players in this segment just won't be able to match right away. And that's what makes it interesting, challenging, and exciting all at the same time.
Yeah, there's this, I don't know if it's a tangent, but there's this myth that there's this real tight correlation between credit risk and income or wealth. And we've proven in different markets that that's not necessarily the case. There are very wealthy people. There are doctors that are just, distracted and bad at managing their credit, and their credit scores are okay. And there's people that are subprime. They're subprime for a reason. And there are people that are low income that are super prime because they have to be, right? They know they have limited access to credit given their income level, or their business is just emerging if it's a small business. And so they have to be super diligent. And so, in some cases it's inverse. And I think having those different views, as Jason said, you can look at credit data and it gets you so far, but if you can get into, what are they actually doing under the covers, and what do the transactions look like? And they actually are, pretty reliable and pretty good risk. And it opens up avenues in terms of how we might approach and have discussions with both customers and businesses.
Yeah, I've been spending the last couple of months diving deep into better understanding, the pains and the unmet needs of the SME and the consumer in Canada, and really the top of the list across the board from citizens is around financial literacy, is around the additional, and it's good timing because we are in Financial Literacy Month in Canada, and the constant feedback is the quote that stands out to me is, I wish my lender provided more support in understanding my finances, my cash flow, helping me, rather than just providing me access and authorization to that loan. So I think you hit the nail right on it with the idea of how can we use this data not only to lend out to a potential near prime or subprime consumer or SME, because we're evaluating them differently, but what are the additional support features that we could actually offer this person to ensure their success, to ensure their growth from a business perspective and a consumer perspective. So I love that. I'm going to pivot us a little bit towards understanding what's keeping you up at night a little bit. So Jeremy, would love to know kind of what's the one or two things that are keeping you awake right now.
Yeah, I mean, the American election is probably,
I should have guessed that. That was the easy one. Yeah.
Yeah. Well, listen, I mean, the reason it is, I mean, there's obviously the component of just, watching maybe the most important democracy in the world kind of blow up in smoke here. But more importantly, I mean, from the Canadian economy perspective, I think, it would benefit us tremendously if the gridlock in the US would end and they'd pass a stimulus bill, right? I mean, I think that the lack of a stimulus bill there, a real serious one, has created a massive hole in that economy. And you know, it's not, I don't worry too much about the US going into a bigger deficit at the moment. I don't think we're going to be stuck crowding out private investment and seeing interest rates and inflation go up anytime soon. So we need that spending. And I think that would benefit the Canadian economy immensely if that happens. So that, I mean, that's one. And you know, we had a session yesterday at CD Howe on the end of the mortgage deferral program and what that's going to look like. And there seemed to be, you know, not necessarily a ton of worry per se, but as you guys pointed out, I mean, there's different segments, right? We don't have tremendous data on the distribution of who's really at risk in different, you know, not only parts of the country, but also, you know, across different sectors, across different income spectrums. And so I do worry about how that's all going to play out when these programs sort of start to come to an end. I think, you know, the Liberal government doesn't seem to be necessarily too concerned about spending, so it does seem like they're going to continue to stimulate. How they do that is a big question, but I do worry. I worry about how, you know, how it's going to go with the American economy, even once we decide who's going to be in the office, and then I worry about the end of some of these programs.
Yeah, I read your article in the Globe and Mail the other day around the impact that it's going to have on our exporters and our particular our SME exporters in Canada. The larger exporters will figure it out and they'll understand a way around it. But those smaller exporters that ship technology in particular, software in particular, and it was fascinating. I encourage everybody to go read that article that you contributed to. Kevin, from an SME standpoint, and you know, the state of lending right now, what's keeping you up at night? What's the hardship?
You know, I think it's about, I mean, the election is one thing, and it's interesting, you know, the 100,000 coronavirus cases a day in the US is another, which means the border is going to stay shut, which means we need to continue to be more or less self-contained in so many ways in our Canadian market. And for me, it's really about whether or not we can just continue to edge forward from an economic growth perspective, because our business relies on, you know, the need for capital to sustain and to grow companies. And that's what we do. We provide that capital, and we do it quite monolistically. I mean, we are not a broader financial services organization that can live off fees on operating accounts like the banks can. We have to put money out the door. And so what's interesting to me is, you know, where does the ebb and flow go with economic growth across Canada, and what markets are going to be there? The GTA has always been, you know, the engine for Canada. What's happening in Alberta with a $35 oil price, and like, it's all very, very interesting. And that's sort of what keeps me awake at night, quite seriously, is just where does the volume come from? You know, we're running at probably 50% of pre-COVID, and that's not bad. And we're inching back day over day or month over month to sort of see gains. But that's what we want to see happen. And we all want to see business grow and do all the things we like to do to feel good about a growing economy. And it's just concerning that, you know, will another wave come back? And you know, we are proudly Canadian flag wavers here. We should be globally, right? We've done all the right things generally, and everybody's got an argument on what we could do better, perhaps. But at the end of the day, we look pretty good globally. We have to keep our discipline so that we can keep our businesses going, and that's what we're trying to do. So that's sort of what keeps me awake.
Understandably. Matt, what about you?
Yeah, I'd echo a bit of that. I think, you know, there's a couple of things that I don't know if it's keeping me awake at night, but I think it's really interesting is, you know, I think both Jeremy and Kevin already mentioned at a macro level, you know, some of the things we're interested in is, you know, and this all ties into, you know, that quote unquote new normal, right? What's that going to look like? And, you know, from a macro perspective, how do some of these sectors make it out of this, right? How does tourism and travel and you know, some of those other sectors that have been like incredibly impacted by this make it out? And from a small business perspective, right, we've seen them get hit, and we hear over and over they're just getting hammered, right? So how do they pull out of this, and what does that mean for long-term employment? How does that look, you know, affect structurally sort of the Canadian sectors across different regions. Again, if you want to turn it back to the election, depending what happens, there's pipeline issues and things like that, and green policies that are all going to affect potentially, Alberta and oil prices and things like that. So there's a lot of that. And then when you think even just to take it down a notch to the consumer, what do they look like, right? More and more people will be working from home. A lot of branches are talking about, shuttering or eliminating physical branch, brick and mortar, and kind of reducing that. So everyone think the lesson learned for a lot of people was, digital footprint. And so how does that change banking? And then taking it kind of full circle back to what I think a lot of folks from the, on this panel and also in our audience are interested in from the alt lending fintech world. How do they take advantage of that, right? How do we, they certainly have the agility and are probably a lot more digitally aligned to that new normal. And how do you get that? And, you think about this industry, and I think we talked about it at the beginning, right? There was an opportunity through this crisis to really emerge and really fund this industry and really support it and get it moving. Again, I take it back to 2008, 2009, right? In 2010 in the US, fintechs made up about 1% of total personal lending in the United States. 8 years later, they make up 40%. By 2018, 2019, they made up 40%. And a lot of that was the aftermath of their crisis, right? And here we are in another one. And I think, and Kevin and Jason probably lived this day, and a lot of people on the phone live this day to day. But, I was just reading a stat yesterday. The top 25 private capital firms in the US are issuing about $800 billion in debt. Or in capital, right? That number is significantly smaller in Canada. So how do you fund? How do you build that wholesale market to support kind of this growth? And and how do the emerging things like the big guys, like the big tech companies, the FAMGA guys, and we just heard this week Apple acquired MobiWave for $100 million, and so those big players are coming in, right? And in some cases already here. And so what does that look like? And so I think it's really interesting. We're in a really interesting time because I think the economy's impacted, the consumer dynamic and behavior is being impacted, and that ultimately affects the market. So I think the interesting thing here is how does this all evolve? And as we kind of the smoke clears, what does the world look like from a banking and lending perspective? I think it's going to be different. I think it's going to be better. It's just, I think there's a lot of right now, just a lot of sort of circling the wagons and kind of getting through it. But, as Kevin and Jason have both said, there's an opportunity to emerge for a lot of growth.
Yeah, it sounds like you're, I hear uncertainty from what you're saying. There's a lot of unknowns that are going to emerge from this, but maybe Jason, what you could do is start to talk a little bit about what's going to be certain, what's going to be sustainable, what's going to be certain over the course of the next 3 to 5 years as we come out of COVID and we move into, I'm not going to say pre-COVID state, but what could we depend on, right? Rather than a lot of the uncertainty talk that we can't really forecast.
Yeah, that's a great question. Well, the one thing we depend on is our data. I can't control what the economy does. I can't control what Amazon and Apple do, even if I wanted to. I don't think any of us could.
Yeah.
The economy is a table stakes conversation at the best of times, never mind in the worst of times. So I'd say the one thing we can control as lenders, quite frankly, is to be very specific around the segments we want to play in, and to be just laser sharp focused on trying to mine and understand the behaviors of what goes on within those segments, first and foremost from the customer's perspective. So understanding how the customer's thinking is evolving, whether that's a race to digitization or a simplification of underwriting or the elimination of retail bricks and mortar. Again, I'd have views on all three. I won't get into them here, but you have to understand how you see those and decide if you're going to make those bets and in which places you're going to play. And then you have to figure out, well, what insights and strengths can I pull from the information I already know about the customers I've dealt with in the past? Is that likely to continue? And then what other insights do I need to go gather about those customers to be able to reach more of them and target them more effectively, notwithstanding whether the government gives them a handout, whether or not Apple or Amazon decide that they want to get into, buy now, pay later type lending programs. You've got to really decide who you want to lend to, for how long, and what your risk return trade-off is. And I think those are the certainties that I would tell you that as a lender or as a member of a lender, I think are within our control. And you've got to decide how you can laser sharp focus your efforts on tackling those rather than necessarily being concerned about or worried about where the future lies. I have those same concerns that my colleagues do, probably as much as anyone does, but I don't control them. But I do control the risk return levels that the company operates, or at least I'm one of many who sets those boundaries. I do control the aggregation and the insights and the analytics into our data to figure out what that's telling me about the consumer. And I'm using a lot of third-party information, whether it's coming from people like TransUnion or other lenders or forums like these, to serve as information hubs as to what I think the future might look like. And then I'm placing a very, very hopefully well-educated and well-founded bet that that's where the market's going to go. And, you know, provided you've got the funding support, which would be the other thing that may or may not keep some lenders up at night, to back you in that strategy, then it's all about execution. So I would say, you know, the execution risk is the other thing that you should really obviously try to control within your own organization, whether you're a small lender or a large lender, is when you're committed to going after a particular strategy, you just have to see it through and be prepared to commit to the positives or the negatives that might come with the risk that goes with it. Because there will be times where you're going to scrape your knee. I will tell you that from personal experience. And there are going to be times where that knee scraping exercise is going to be the best education you've ever asked for. And it will inform you to make a better decision going forward. So I think those are things, you know, thematically that I think we as lenders have to think about as we move forward, is to try and understand the market as best we can, place really well and understood bets, use data to inform our decisions. And going back to something that Kevin said, and we support this and, you know, violently agree, is test and learn as often as you can. Just don't test and learn all the time that you're putting all of your money at risk. But you've got to test around the edges to figure out where the next opportunity is going to be.
You know what's interesting, Jason, is that, you know, to your point, as long as your customer base is growing and you're doing what you've just articulated, there's a tremendous future out there 3 and 5 years for your firm and for ours and others. I think the interesting point that got caught up that we kind of missed over a little bit is around the education piece, because you know, we're a 35-person company serving across Canada. How do we actually add education to the process? I mean, and where should education really start? Because the small business owner or the consumer who's looking for capital to refinance or to grow or to improve their quality of life, how do they make decisions on what the right product is? And there's so much out there, and so many different products are actually trying to solve for the same need. It's really quite interesting. And often I think, certainly in the commercial world, the borrower ends up with the wrong product. And it may be that they don't have choice, but also there's an education factor that if we could add education, if the masses that use our products and services knew more, and those that don't knew more about us, we'd be even improving. We'd be so much more improving our own positions in our market shares or in our space, in our peer group, and the public would be better off. But we're still not as well known as we could be, and we have so much to offer in terms of education. It's a really hard piece to scale, you know, to try to get out to everybody. You know, how do we do that? How do we help? Because we all want to do that.
Yeah. I hear you loud and clear. And yeah, I did glance over the financial literacy and education topic. But one of the key insights from the work that we've been doing is, you know, you have this small business coming into focus for you. They're going through the application process. Wouldn't it be great to say to them that what you actually need is invoice factoring or account receivable financing over working capital loan? Wouldn't it be great to tell them exactly what product that they're able to best utilize in circumstances that they have? And I think that this is where, you know, a combination of consumer and consumer directed finance, open banking data coming in, fast evaluation of it, algorithmically looking at them from a cohort analysis and saying, you look very similar to, you know, these 20,000 other people, right? We know that these 20,000 other people could use a product like this, instead of choosing a product like Y.
Well, so many of them, Mark, are compatible. I mean, the
Yeah.
simple point you make about an invoice discounting. I mean, there's a working capital that helps produce the product, and then there's a discounting that helps get your cash forward from selling it. I mean, this is nothing new. It's that I think there's just a lack of knowledge generally in the marketplace, and the reality is we're actually all more compatible and absolutely could be working more together as a broader specialty finance industry than we do today. And maybe that future is out there, that there is some M&A within our space at some point as we all mature in our environment. And Jason could, I mean, he's the leader in his field. He could be tackling the commercial markets at some point and see how it all goes. And we could be doing the same in part in the consumer space. And the plethora of different financial tools sort of comes through, supporting your customer. That's really traditionally how it grows. And so it's hard to say, but I think leaders that will be around like goeasy in 5 years will see some expansion to their products and services. We will continue to see some decentralization from the monolithic growth of the big banks that will always be there, but there is going to be increasing opportunity for the likes of specialty finance to grow, especially with open banking as it does come, and it will take time. And I think that's actually exciting of sort of decoupling some of the financial services activities without losing the regulatory pull that we always have in the Canadian market. I think it's actually quite exciting.
Yeah, it's one of the trends. I recently read a great report. I can't cite the name because I can't remember the name of it. Too many reports, but it talks about this concept that Kevin's mentioned called what they call added value lending, which is that we basically are in the business of lending money. That's how we make our spreads. That's how we justify our coming into being. But there is quite an emergence of a trend in other markets, the US in particular, where that lending relationship is not defined exclusively by the lending transaction itself. It's more defined by everything that goes on around that transaction. One of which could be this notion of helping customers along a spectrum, if you will, which includes having a diversified set of products that maybe you as a lender don't have, but you can connect them to. So partnerships takes on a different role. So companies like SoFi and other organizations in the United States have gone away just from being these once in a blue moon transactional lenders to wrapping these other bells and whistles around the services they offer. And I think that's one of the things that we as an industry group can think about, because it is an emerging trend. And as consumers become more sophisticated and demand more of us as lenders than just simply access to capital, I think that's a space we could think about how we play more aggressively, because it is a point of differentiation. And I would argue in some way, shapes, the organization or organizations that figure that out have a leg up on those that don't, because you can't always keep on scale. You can't always compete on access or cost of capital. You've got to differentiate yourself in some other way, and giving a different perspective to the consumer might just be that way. And it's something that we as a group might want to think about more.
Mark, can I just jump in? Just a few things popped into my head because the conversation has gone in a few different places since you asked the original question about certainty. I think, in my view, it is going to be certain that the traditional risk metrics for financial institutions are going to make it difficult for them to lend, even once we get this recovery going. So, I mean, to me, there's a huge opportunity for you guys to tailor your products in different ways. Like I just really think there's going to be a lot of space. There's a lot of working capital that was wiped out as a result of this. And so to me, there's just a huge opportunity on that end. All this data conversation, those also made me think, and this is my second point around issues around PIPEDA and the digital charter and all these, all these policies that have sort of started, but aren't quite complete. I think there's some missing pieces around these privacy issues that I think, perhaps it just needs a push from organizations like yours that are really, that use that data in such a productive fashion, for the economy. And then the third thing is, Kevin mentioned it, was, regulation. And the open banking story is going to be super interesting from a regulatory perspective, because in other jurisdictions where you have one or maybe two regulators, you don't have that here, right? You have, not only do you have fragmentation geographically, you have fragmentation functionally in the financial services sector. And so what does regulation look like for the digital space? That is a huge question that I think needs to be spent. There needs to be a lot of time spent on by everybody who thinks about these things, because without it, it's not clear to me that you're going to get all the benefits from an open banking, right? Because in other countries, it's really open financial services, right? But here it's not, it can't be because of the regulatory structure. And so I think a lot of thought needs to be put into that.
Yeah, I think we're seeing that, right? We're seeing in the discussions that are already happening at a federal level. I think, you know, we're getting to the idea that one size doesn't fit all, right? Government needs to modernize financial regulations to better encourage innovation in the Canadian marketplace, for sure. And I think there's, you know, a lot of belief that there's considerable room for innovative policy reforms, especially around fintech, right? So opportunity zones, regulatory exemptions for P2P lending, including small businesses, things like that. And I think those are things that are starting, like those conversations are starting to happen, and they're necessary, right? They're necessary to support the industry and kind of create that structure.
I just want to pause there before I open it up to the panel. So the Q&A box has not been filled. Great time to start asking some questions in here from the participants from the audience, and then as they come in, I'll just throw them out there. But as the audience is writing those Q&A questions, if there are any, maybe what we could do is just start thinking about a parting thought. One thought, one opinion, one outlook, one forecast about how we see the lending space for the alt lenders, for the lend techs that are listening on this going into the next 5 years. Matt, you want to kick us off?
Sure. I think obviously the one word I'd use is change, right? So I've already said it. There's going to be a change in the consumer dynamic. We know just from you know, the new generations entering the consumer market, they bank differently, they think about finance differently, and so I think there's going to be, and you know, that's what's driving things like open banking, right? That kind of thinking and that kind of consumer demand. So I think that's going to shape how this industry emerges. And I think this industry is very well positioned to excel in that space. And so, you know, I feel very confident that this, you know, kind of all lending, fintech, whatever you want to call, is going to be a high growth industry. I think it's just, you know, we need to be able to support it in terms of capital, regulatory, and you know, Jason's note about, you know, organic and inorganic expansion, right? And I think that's going to happen, and I think that over the next couple of years, there's going to be more and more prominence, because you know, those younger generations that are on their mobile phones, or those businesses that are starting up that are looking for solutions that maybe the traditional avenues don't allow. You know, they're actively seeking that, and I think that's going to drive the appetite.
Oh, we got one question that came in the last 2 minutes here, so I'm going to read that before I turn it over. So there's been a lot of discussion on alt data, how this is central to the fintech lender sector. Can you give some examples of innovation sources of alt data in the market now, and what data we need moving forward? So Jason, Kevin, I'll turn to you guys, because you're more in this space right now, and then Matt would love your opinion afterwards.
Sure, I'll kick it off. I mean, Jason's got a lot more under his belt in terms of risk than I do, but I will tell you that the best data comes out of the historical performance of our own book, and that is hugely important. And that's the hardest piece. In fact, the barrier to entry into our business is really not capital and innovation. It's actually getting a hold of data to build a proprietary credit box. That's really the challenge. And so, you know, data, the use of data is hugely important. How we deal with that is driving hypotheses on that data through historical review of performance on our own book. That is effectively how we have leveraged data. In the early days of my business, we bought that data. We bought it from the bureaus to help us try to establish some protocols on what we will look for and how we'll manage. And then as the business grew, we used our own data to provide for the software that we use through Judy.ai, frankly. Jason, your thoughts?
Just come off mute, sorry. Yeah, so I loved your summary. I would say having the ability to access and mine data, statistically evaluate using good techniques, testing and learning, writing good hypotheses, and rigorously following them, and not letting them fall to the wayside is by far and away one of the most important approaches. As far as data itself, we've talked about banking data. That's a no-brainer. I think there are several other sources of consumer-related data that people would love to put their hands on. It's somewhat problematic to figure out how to do that in a way where the customer experience can be seamless. And what I mean by that is when a customer approaches your doorstep and wants to borrow money, or at least talk about borrowing money, you would ideally love to get that full range picture of that customer. And you'd love to be able to get that once and once only by getting the customer's consent to ingest all that information. Well, there is as yet no one simple location where you can do that. You got to call a credit bureau. Maybe you got to call a banking partner like a Plaid or a Flinks to pull in their banking data. Maybe you got to partner with a utility company or a utility aggregator like an Urginet to get the utility data in. You've got to figure out a way to get all that information in one experiential loop, because if you do it sequentially, it's not that you can't get that information, but the customer experience is going to absolutely stink. And the customer won't have the patience. And more importantly, they're going to be concerned about, well, why do I need to give you all this stuff just to figure out if you can lend me money? So I would say the other really interesting source for me of data is web data. And by web data, I don't mean social media data. That's interesting, albeit fraught with some interesting loopholes and conundrums I won't bother getting into here, but just the simple notion of how your customer interacts with you digitally. If we're all talking about building these grand digital ecosystems, I would say there isn't one organization yet that I've seen, at least in the Canadian market, that's figured out how to capture all of those data points and then mine them for the purposes of determining their predictive power, whether it be for credit, whether it be for loyalty or any other matter. And to me, that's the next great frontier that I'm looking at, is how do you begin to grab that web data by the, wherever you want to call it, ingest it, and then assess its value and worth. So that would be another example, I think, that's waiting for us lenders, those of us who have built digital ecosystems. And even for those of us who have, I will submit to you, we can do a much better job of doing it, because lending itself is a discipline, and it involves pricing, it involves risk, it involves a whole bunch of things. But this whole notion of capturing information properly about how you interact with the consumer, that's a whole other data set that you don't necessarily have to be the world's greatest risk manager to do, but you're going to need a lot of smart people to figure out how to trap that information and then put it into your ecosystem. So those would be a couple of opportunities I would outline for the people who are looking to make a difference. Go after your web data and figure out how to mine it, because there's a treasure trove there. And here's the other thing, that's not governed by regulation. Those are customers' direct interactions with you. So we all talk about open banking and what it might mean. Customers freely transact with you over the web. That's your data, right? That's something that you can mine and you can own. It's just figuring out what it looks like and how you can leverage it. I think that's the opportunity.
Tal's giving me the shoulder, saying, "Wrap it up, Mark." I just want to thank the panelists for a great conversation today. Very insightful. I want to thank CLA for hosting, and TransUnion for being the sponsor. I learned a lot today, and it was a great conversation. So thank you all. Tal, I'll let you kind of close us off here.
Thank you, Mark.
Well, those are some great concluding remarks, Mark. So I'll just say thank you, everyone, for attending another CLA session. We'd love to obviously have you back at the next one. And thank you to our esteemed and incredibly thoughtful panelists for a great discussion. And again, to TransUnion for supporting fintech lending innovation and the CLA. So thank you very much. Have a great rest of your day.